Decentralized finance is an extraordinary innovation. It makes markets faster, cheaper, and more transparent. Who knows who said those words? Raise your hand. It's Larry Fink, CEO of BlackRock, the largest hedge fund in the world, $10 trillion asset under management. And with that quote, I wanted to open our panel about RWA liquidity. Whoa. That's a heavy panel. Give it a round of applause. Okay,
we had too much dessert at the lunch today, so we...
Well, let's try to roll with that, I believe. I'm Marcin. I'm co-founder of RedStone, which is the fastest growing oracle on the market right now. We specialize in pricing both on-chain and off-chain assets, so including the RWA tokenized assets, but also crypto-native ones. And I would like to start with an intro from each of the panelists, with also a flavor, what does your company or entity has to do with RWA and RWA liquidity? Hilmar, maybe we can start.
Hi, everyone. I'm Hilmar. I'm one of the founders of Arrakis, also co-founded a company called Gelato before. And what Arrakis does is we help projects to create deep spot liquidity on-chain. So we work together with a lot of the top RWAs and DeFi protocols and manage the inventory across UniV4, Aerodrome, PancakeSwap, and all the major DEXs on all the major chains, basically.
Hi everyone, David Vatchev, Head of Tokenization at Fasanara Capital. So Fasanara is an alternative asset manager focused on private credit, so that's our real-world asset management side of things. We also have an in-house crypto hedge fund, which has been around since 2018, a market-neutral, delta-neutral strategy that has been active. So our role, and especially relevant to this panel here and a lot of what we've been discussing all day today in many of these sessions, is how can we bridge the safety, security, stability of real-world asset yield? How can we bring that on-chain and make sure that it's both liquid, composable, and innovative for all the use cases we're looking for in DeFi. So really excited to be on this panel.
Hi, I'm Dennis Dinkelmeyer, the CEO and founder of Midas. I'm proud to share that Midas is the RWA issuer with the most composable tokens in all of DeFi. So we've partnered up with Fasanara Capital, but also with MEV Capital, RE7 Capital, and Ash Capital, and have tokenized certain strategies, and have brought them to Pendle with YTs and PTs, back to Morpho, back to Euler, and we really focus and embrace the composability of tokenization. Very proud to share among the fastest growing players in the space with over 250 million in assets in TVL.
Sébastien, co-founder of Steakhouse. We are the leading creator on Morpho, which is the lending protocol. You might also see just a few panels before that we launched Grove, which is institutional credit managed by Sky, that will invest up to 1 billion in CLOs, GAAA, from Janus Anderson. And we are also providing advisory services, and we had started the real world asset journey since 2020 at MakerDAO.
Alrighty, back to the audience so that you are still energized. Raise your hand if you have a crypto wallet, Ledger, MetaMask, whatever. All right, so today it's probably 90%. Yesterday at RWA Cannes, I asked that question, it was like 65, 70%. So glad to see the audience over here is more DeFi native. Talking about on-chain finance and DeFi, Hilmar, based on your deep DeFi experience with Gelato and Arrakis, can you tell us your perspective about creating liquidity for real-world assets, what it actually means, how to achieve that, and why does it matter?
Yeah, what does it mean, liquidity for assets? It's a very philosophical question. So liquidity is really, I think, what underpins the sort of value of an asset, right? So it means, can you exchange an asset for another asset, for example, like a stable coin or something else, and in what sort of time period and at what sort of price? And I think the real cool innovation of DeFi, of course, we talk about like instant settlement, clearing, and so forth, but it's really is, I think, a synchronous composability, right? So I'm very bullish that a lot of like private credit bonds and so forth are coming on chain. tokenized securities, because you can loop them, you can borrow against them, you can leverage into them, you can, instead of earning like 7% on a private credit tokenized fund, suddenly you can earn 9 to 10% with like conservatively, just like a bit of more risk, but just better like composability and better like borrowing rates and so forth. And all of this is really underpinned by liquidity. So there's, of course, liquidity from like primary venues, like, okay, you can redeem from the issuer of the asset. But this is usually like, it takes a bit of time, a couple of days maybe, and it's usually best for like large sizes of like redemptions, let's say. But if you want to integrate into DeFi, if you want to make composable strategies, if you want to do like looped vaults where you borrow and like loop back into a position, then you really need usually spot market liquidity. And this is really what Arrakis is focused on. So Arrakis works with token issuers of RWAs, stablecoins, or like just like utility tokens, governance tokens, and they can deploy Arrakis Pro vaults, and these vaults run automated, highly concentrated strategies on top AMMs in order to create depth. And through this spot market depth, we can allow cool strategies to be built on top, and people actually redeeming back these assets into stablecoins, which then unlocks this sheer endless possibilities of building these tokenized strategies that Steakhouse is building, Gauntlet is building, and so forth. And so one really cool thing that we actually announced today is from today onwards, have a really cool new strategy which is focused on yield-bearing stablecoins and RWAs. So Maple is actually like the first company that is going live with this like as we speak right now. The team is deploying it at the moment, and so it's like basically the best, most capital-efficient strategy to create market depth for yield-bearing drifting pairs, such as like a syrup USD to USDC on Uniswap, for example, where we synchronously, atomically redeem against like the primary redemption facility. So yeah, that's really what we focus on. That's why liquidity is important. And that's, I think, yeah, why you have to invest a lot of effort and also like money in enabling this, because only then, I think, will your asset actually be successful.
Crypto trading is almost all about liquidity of Bitcoin, ETH, and other assets, but tokenized assets have it to do with itself that in regular world they are illiquid. So Dennis, you're working with tokenizing wide range of funds and assets, including real estates. What makes creating liquidity for traditionally illiquid assets, like properties, so challenging, and how are you solving that?
Very good question. The topic of liquidity is very, very important. Firstly, the biggest challenge is actually two major challenges. The first one is actually a big regulatory complexity. Liquidity, at least in the context of swapping assets, particularly securities, even crypto assets, is a regulated activity, multilateral exchange activity, unless it's an OTC transaction. So actually, many of these challenges in the past in the market have been limited by this. There are some attempts, like regulated centralized exchanges and otherwise, but so far they have not really built large traction. The second problem actually, and I think we should, I believe at least, that liquidity alone and tokenization are two distinct challenges. I believe liquidity will never be on the blockchain itself. The latency that one computer can achieve versus multiple nodes can never compete with one another. And the data point that supports this thesis, in my view, is that actually the deepest liquidity in ETH is on Binance, not in Uniswap. So even in a crypto-native assets, the liquidity actually is not on chain. It's actually on Binance. And then liquidity attracts liquidity, so price discovery ultimately happens at venues with low latency, and it's very, very hard to compete against it. And I know people saying blockchains get faster, all of that. But I think it's very hard to compete on that specific swap liquidity. Now, like you have pointed out, it's actually a very interesting component that liquidity in itself does not necessarily mean selling an asset, but rather redeeming and issuing an asset. And that indeed, in my opinion, is a super interesting component, because ultimately the users want to settle in the dollar asset and they don't necessarily swap for another asset. So to your point on how we have challenged this, solved this, I'm actually quite happy to share that we've never actually published on this yet, but we've been doing this for the last 6 months. But across certain assets that we support, that all have the same duration assets, we have one pool of capital from which liquidity can be drawn on. This pool of capital sits in T-bills, so the redemptions ultimately happen directly from an atomically redeemable instrument that is sitting in a sleeve that earns yield in T-bills, is risk-free, and then is rebalanced at the issuer level. And this happens behind the scenes. It's really just a means of settlement. The way we compensate for this is that we effectively charge a redemption fee, and that is reallocated to that pool of capital. And that ultimately is something at some point, we have not released this to the public. This is really an experiment. But this is something at some point we'll bring to the market and effectively allow other asset managers and other strategies we bring on-chain, such as Fasanara and others, to benefit from this. So we're not just a tokenizer, but we bring assets on-chain with liquidity built in the primary market. And this is thanks to the innovation the industry has built. Tokenized T-bills were a novelty at this summit 2 years ago. Now they're a commodity.
Okay, let's go second level of the question. Then, who has ever used a looping strategy in DeFi from the audience? Raise your hand. Looping strategy. All right, from 90 we went to 50% probably. So a looping strategy in short is you're taking an asset, you put it as a collateral, usually as a yield-bearing asset, let's call it LST, like wrap staked ETH from Lido, and you would borrow ETH against it, put it again on Lido, you have wrap staked ETH, and you repeat the process, right? So that you leverage sort of the yield that Lido is giving you. And currently on the market, there is not enough liquidity on-chain or on DEXs to close all the positions of looped liquid staking tokens. But they are redeemable on Lido and other liquid staking providers. So Sébastien, as someone building oracles myself, I'm very curious how does Steakhouse Financial approach fair price discovery for real-world assets when traditional market mechanisms don't exist or have a very shallow liquidity?
Yeah, sure. So when we create a market on Morpho, which is a lending protocol, obviously you need to price the collateral, and for that you need a smart contract giving you the price. For some collateral like BTC, ETH, there are providers like Chainlink that provide you a price and you can use it. There are some details, but broad and it's quite easy. Now, for instance, for MF1, which is an off-chain asset, tokenized off-chain asset, then you need to have something a bit different. And what we rely on usually is not the market price, because currently there is no market. But even if there was a market, the liquidity would be shallow, which means that anyone can come, manipulate the price, trigger liquidation, and maybe make some issues in the market. So we cannot use those prices except if it's quite deep and quite resilient. So usually for those kind of assets, we use the NAV, the net asset value, provided by the fund administrator. And then the question is just how do you take this information, which is based on compliance, and put it on-chain so we can read it. For MF1, it's a bit more complicated because there are the F1 underlying, there is a T-bills component, so there is some kind of aggregation going on. But overall, it ends up on the blockchain, and we can use this price to price the collateral. For MF1, it's one price per week. So why is it fine? It's fine because it's an asset that isn't volatile enough to create an issue. Obviously, if it was a stock, let's say NVIDIA, having one price per week is not good enough because you can have a drawdown of 50% in a week. So it always depends on the kind of asset and what is the volatility profile of the asset. And so that's why the second part that you can manage this collateral, this oracle risk, is to apply a discount. So you will not be able to borrow at 100% loan to value. You can only borrow up to, for this product, for instance, up to 86%. And what we did actually is to make a discount on the oracle that is provided off-chain to add another layer of protection.
In the next year, we can expect aggressive looping strategies and complex structured products built on top of tokenized real-world assets. David, from your institutional perspective at Fasanara, how do we avoid building on-chain the same house of cards that collapsed in 2008 with CDOs? Yeah, this is the tough one.
Yeah, it's a good, fun question. I'm glad we still have enough in the audience from 2008 to remember that time. But you know, our take on this one is, if you look at some of the what happened around that time, it was a case of lack of transparency. It was over leverage. It was poor credit underwriting standards. So all of these things, whether it's 2008 or so, simply replicating them is what's going to cause the problems. So ultimately, it's a case of not making those same mistakes again. Now, what's interesting in terms of how we've structured this, and the token that Sébastien was referring to, the MF1, is a tokenized representation of Fasanara's one fund. So that is diversified short duration credit as well as a digital asset sleeve. So it serves as an all-weather fund. But right from the start of that is ultimately what is the credit underwriting of that entire fund. And it's been great to work with partners such as Steakhouse who are really coming on site to do that due diligence here. And then that starts right on that basis. How are we getting these NAV numbers? What are we doing underlying? How are we ensuring that the originators sourcing these loans are actually able to do so and enforce those in regulated manners? So even if the company itself goes belly up, there is always a recourse mechanism. So this kind of starts right from this angle. And it's been great working with strong partners such as Midas here to bring that on chain, because the liquidity component that we were discussing here is such an important point. It starts really at the fund structuring level. So what can we do to make sure that the credit underwriting process is not compromised, but we come up with something that can address that duration mismatch between TradFi and between DeFi. What we want to do is make sure we give superior, consistent yield, but we have to deploy that in the real world, and at the same time make sure that we deliver that in a liquid token form so that it can be leveraged from DeFi investors in lend loop strategies.
Brilliant. Duration mismatch. I want everyone to remember that. You probably heard of Silicon Valley Bank collapsing, so that was what killed that bank, essentially. Like, because on paper, some of the assets, were actually covering, like the people willing to redeem, but the duration of the assets that were having in custody didn't allow to do that. Okay, opening up. Let's talk about the killer use case. What specific real-world asset category do you think will achieve genuine, deep liquidity first, showing the way for others, and why it will be that one?
So it's a tough question, obviously. We all want deep liquidity for real-world assets, because that's the way of people don't want to go in a long duration asset. For instance, MF1, there is a liquidity sleeve, but then it will take a few weeks to redeem. And in crypto, we live in 12 seconds. That's the longest term we can think of in crypto. That's how we are today, at least, with all the speculation. So we need on-chain liquidity to be able to absorb the real-world asset when you want to sell it. Otherwise, you will not buy it in the first place. So this is kind of a tricky part, and that's why we are building tools to create this liquidity. And I don't know which one will succeed, but the idea is, for instance, we created a repo market or a lending protocol to have those real-world assets as collateral, and that's quite interesting. You might say, well, why do we want to have private credit as collateral? Well, if you think of it, what do you need when you want to sell is someone on the other side to buy it. Unlikely that you will find someone that wants to buy it and hold it. You might find more likely a market maker, or what we can call a balance sheet capacity, someone having the balance sheet disponibility to buy the asset, go to the issuer and redeem it, dispose it for the next 3 weeks, or let's say up to 1 quarter. So that's why, for instance, with the Grove, the star of Sky, dedicated to institutional credit, there will be many billions of balance sheet capacity ready to absorb those outflows if there is a need. Then on the lending protocol side, by having the capacity to use this real-world asset as collateral on Morpho, you can then make the balance sheet capacity more efficient. Because you cannot only just hold it on your balance sheet unleveraged, but you can fund yourself with this collateral, and so use way less equity to hold those assets. So I think those are the tools. We still need to find, maybe with Arrakis, how to fix the on-chain liquidity itself, because this is more OTC. You need to have a market maker on the other side and coordinate OTC. How can we do it on-chain? And that will be the last unlock, but I will let other people explain.
I give my perspective on the topic of what will achieve product market fit, and I'll do it in 2 levels. I do it at a global level and at a crypto industry level. First, on the crypto industry level, I believe we already have product market fit with real-world assets. specifically USDT. USDT is the ultimate real-world asset. So homogeneous, you can trade it with deep liquidity. And arguably, I would say, Tether does not get enough credit for the work they're doing south of the equator in emerging markets, where it actually allows people access to inflation protection, to liquidity, and to a medium of exchange. Within crypto itself, I believe what Sébastien has highlighted, particularly with Maker, the way to achieve liquidity in tokenized assets is exactly with a project at Sky. I really admire the work there, because ultimately tapping on existing liquidity that allows transfer of an existing asset is vastly cheaper than building liquidity in multiple instruments. And it's exactly the same architecture decision we've taken at Midas, where instead of putting DEX pools of 5 different tokens, we've effectively have one redemption pool. But this will have its limits of scale. The scale that Maker has achieved will ultimately allow to tap in existing liquidity, duration matching, and allow effectively become a vehicle to have a yield transfer and become a savings product, which is very, very interesting. And I think a lot of tokenized assets will plug into this. And I hope, of course, we get a slice of that too. Now, on a global level, and a global level specifically to the crypto market, I have a very sober view. I believe we have achieved very little, unfortunately, other than looping use cases. I don't know anyone in the room that has had the benefit of solving a real-life challenge using crypto. And if you have, I'm not envy of you, because you probably have fairly big problems. But that being said, if I look at the things that give me hope, I would actually say that from my background in financial markets, the elements that attract me and the elements that are very interesting are exactly the same use cases that we use here. Repo use cases, like the JP Morgan Onyx chain, where you can have repo lines 24/7, settlement certainty of the actual instrument. That is extremely interesting, because settlement layers, agencies, they're limited to 9 to 5 during trading hours, and you take counterparty risk. And when you look at what Fireblocks, Copper Clear system, how this has been handled, this can actually be achieved with tokenized instrument. It's very, very, very challenging. If you ask me to bet whether it will happen, I'm not sure if the answer is yes. I hope it will be. But these are my two perspectives on this.
Yeah, I mean, I echo many of those the sentiments, but let's pick up on the stable coins, because that is an important point. It is clearly the RWA that has found product market fit, but let's unpack that. And it starts with the US dollar is the world's reserve currency. So people inherently wanted the underlying asset. Okay, and now why did they want it initially? That you need a stable unit of account in DeFi. You need a settlement currency for crypto trading. And that's where Tether and the like started off. And that found product market fit, and that's been doing the bread and butter. Nobody was talking about yield bearing or so, because it served its purpose. Now we're seeing these second layers come about, including accessibility to emerging markets, remittance, corporate treasuries, et cetera, et cetera. But it is important that it took a while, and it found its product market fit there. So really what we need to think about this starting as a point is who wants that underlying asset? Likewise, what is the use case on chain that can't be recreated? And then what's the distribution mechanism? Tokenized stocks are obviously the hottest flavor of the month. We've been through this before, but why are they working now? Because of distribution. A lot of exchanges are able to do this. The use case still stands. And this is what we're finding. Now, why I think it's so interesting looking at credit, looking at private credit, and for those of us unfamiliar with this, you're talking about effectively non-bank loans to a private company and an off-market transaction. Why that's so interesting is preservation of capital and consistency of yield. So again, why is that so helpful within crypto, and why is it finding product market fit here? Because you want to find something that will give you consistency of yield during those downturns. That's something that you can't really get, because everything else is effectively correlated with crypto markets. So as this matures as an asset class and we address that duration mismatch, I think this is something which is really going to grow in scale as an asset class within crypto.
Yeah, maybe 2 points for me, just echoing. I think private credit will be very interesting, especially as yield for treasury bills and so forth might go down over the next couple of years, who knows. I think DeFi definitely wants a certain sort of yield level, and then if you can get with looping a 9 to 10% APR, I think that's extremely attractive, and it's a pretty liquid market in real life. And so crypto doesn't necessarily just create liquidity out of thin air. There needs to be people wanting to buy and hold these assets, right? And so this is an underlying assumption. And I think to the point of on-chain markets not being so like still very thinly spread in terms of liquidity, actually they're pretty liquid. Like if you look at this, like I remember with Sky or MakerDAO, like one of our first projects at Arrakis was creating a tokenized Uniswap v3 position for DAI USDC that were able to leverage up to like 50x, and you were able to swap in and out $100 million worth of stable coins at basically no slippage, right? So there are tools. The tools are there to do it, especially for correlated assets. If it goes to like uncorrelated assets, this is where like we have to like execute our strategies to make it work. But it's there, like, and there's a lot of volumes happening on chain. Sometimes even more. Like we are 30 to 40% DEX to SEX volumes these days, right? And so my big sort of prediction is actually we will increase, we will get to close to like maybe 70, 80% very soon in the next couple of years. And I already see the flippening happening where on-chain will become the dominant venue of a price discovery. I think we are not too far out there. So yeah, I think we're actually already pretty advanced in that stage.
Very interesting. One thing I want to emphasize here is that T-bills yield is not dependent on us. It's dependent on the US government, right, when you're talking about the US treasuries. But when we're talking about private credit, and I agree that I'm bullish on private credit, there we have a lot of tools where we can tweak, right? Like we can go a bit more aggressive private credit, give a bit more aggressive loans, higher risk but higher return, or lower risk, lower return usually. But the reason I'm bullish on private credit is because we are kind of like the owner of the strategy in a sort. And we are talking about the price specifically because when you do those looping strategies, you can also meet the unhappy path of liquidation. So your position is underwater and it has to be sold on the market. As an oracle, we can serve two types of prices. One is the market price, so how it's trading on DEXs like Uniswap, Curve, Balancer, or Binance if it's listed on centralized exchanges, or something that we call fundamental price, which means what is the net asset value that is sitting on a custodian, on an admin level. And usually with that one, we have only one source. We have the admin of the fund. And literally half an hour ago, together with Securitize, one of the biggest tokenization platform in the world, RedStone announced a new framework. You can Google it right now. It's called Trusted Single Source Oracle, which allows, without utilizing web proofs, for mathematical provenance of information that is coming from the web. So as we venture more and more into that space, I believe this on-chain liquidity will serve for small-sized liquidations. Let's call it $50,000 for TradFi, it's peanuts. But if you would to liquidate, let's call it $50 million position, then on-chain liquidity, I doubt is going to reach that level anytime soon, right? Then you have to look into the redemption, and then many times you need to have a counterparty that is going to help you facilitate that kind of like offloading, because there is a duration, right? Like private credit, for example, what's the duration with Fasanara private credit?
Well, yeah, it's a very interesting question. So private credit typically involves term loans. So effectively, this is called direct lending, which are over multi-years. But now for Fasanara, it's actually short duration. And this is just how we worked with this team. So 60 to 90 days is the average for our investment-grade receivables.
But still, it's 60 or 90 days that you need to wait. It's short in relation to TradFi, but it's very long in relation to crypto, right? Like, who waits 60 days in crypto, right? Like, you want instant. You want to sell it now, or you want to liquidate the position right now. So as we are venturing to the end of the panel in 6 minutes, we love bold predictions. It's July 1st, 2025 today. Fast forward 3 years ahead. By 2028, what are your strongest predictions for RWA trading volume structure and liquidity dynamics? And also give us the percentage chances that you believe it will materialize. So who wants to start with a prediction?
I can start. I already told mine, but in 3 years, DEX volumes or like on-chain trading volumes have flipped centralized exchange volumes. Yeah, 100%.
100%. 100% in 3 years, on-chain volume is going to surpass Binance and Texas. Very bold one.
Yeah, of course, 100% prediction on everything that I say going forward. I would say, look, I'd say probably there's two things. Firstly, secondary markets. I think Dennis made a very strong point there in terms of the limitations, but I think the regulatory landscape is changing, and I think that secondary market liquidity will be a game changer in this entire space. And that's And then I think diversified real-world collateral within DeFi especially is also going to explode. I mean, where we currently stand, of all the real-world assets and financial securities out there, under 1% have been tokenized. So it shows you how much we still have to go.
My prediction, this year will be called Private Credit Summer, just like RWA Summer 2 years ago. In terms of numbers, I think the industry is doing very well printing numbers, whether they're real or not real, but there will be big numbers. I think liquidity remains off-chain, that's my thesis, but that doesn't mean that these issuance and redemption vehicles, or for example stablecoins, in some instances will build this liquidity, but there are many views on this topic. And I believe we and others will do well for this as an industry, as an aggregate. Like David has mentioned, I believe the change in the sentiment in the US, particularly in light of regulatory topics, has really been a paramount change. Coinbase buying Derivaux, Coinbase announcing tokenized stocks, and this ultimately actually is making pushing the industries forward. Most problems have been solved by US capitalism, or most at least business problems have been so far, and that part of the reason why the industry does not advance too much further is because we've had the US persons, the largest capital markets in the world, being largely locked out. So it's extremely exciting. I think private credit will be very large assets. I think stocks will be large asset. And ultimately, this is very important because the ledger itself transfers assets with value and accounts for assets of value, making the gas token that secures the ledger more valuable and all of the industry more valuable. So that's my prediction.
Sébastien?
Having been in the real asset space for quite some time, the only prediction I can make is that it's always taking longer than expected. That's for sure. But I think there is, to be a bit more serious, I think there is a great path ahead of us. Now there is still a lot of issues that we need to fix. The main one is the regulatory one, because if we want to deal with real asset on-chain, we need some regulation to change, because we have the broker-dealer issues, some stuff like that. Because yeah, Uniswap, is it a broker-dealer? Remember, 1 year ago, everyone using Uniswap was a broker-dealer and had to register at the SEC, which was obviously impossible. Now that was removed, so we will see. So on that front, regulatory will be an issue. So I'm not in charge of regulatory in the US. It seems we are going in the right direction, but we will see. It's mainly for crypto speculation for now, not so much for securities on blockchain. On the second side, the usage is also quite important. We see this year a real push of increasing TVL or market size of real asset on-chain with T-bills that started 2.5 years ago. I remember I was there and it was starting super slowly. Now it's ramping up with notably a Bridle, and DAO is investing in it, so that's great. Now we might have equities, we will have private credit. Will there be a lot of trading on-chain in 3 years? I'm not sure there will be a lot. It will be mainly still on the primary market with people going to the issuer, having permission token. But we can hope for the best.
Okay, my prediction is that in 3 years, we are going to have millions of assets tokenized.
Woo!
Many of them are going to be trash, unfortunately, because if you tokenize something, it doesn't mean it gets some superpowers. Like, of course, it gets the superpowers of crypto, right? But if it's like bad asset in traditional finance or in traditional world, it's not going to magically become something extraordinary in on-chain. But we are going to see from those millions of assets about 10 that will rock, that will create the on-chain looping that we know from a liquid staking tokens market, and it's going to be regular. And then we are going to see structured products for the retail where they just click once and they loop, for example, private credit 7 times and they get a specific risk ratio and then the percentage yield they're getting over the year. Half a minute, one word or a couple of sentences, a couple of words to finish.
I was going to say, Marcin, you should be careful with broker-dealer activity. It was just a joke. Of course, not investment advice. Of course.
Any closing thoughts?
Look, from my side, it's important that tokenization, hopefully from all these panels, everything, does not equal liquidity. It's accessibility. And I think this is what we're all working towards. So,
final thoughts. I want to thank you for the panel. Thank you also for the team at Steakhouse and Fasanara for the collaboration of the last months. I think looping is extremely important. We're delighted to bring this to more chains, Rootstock, ZeroJAI, and others base. So we're super excited about the future, and thank you very much for having us.
Thanks a lot for listening, and a round of applause for our panelists.
Thank you.